Thank you, Luca, for letting me speak today as well. I think the real reason you probably got me up first is because I've probably got the most jet lag out of everyone. It's probably something that as the day goes on, I'll probably start tiring, so appreciate the opportunity to go first. And as you touched on, I always just reflect on, again, my parents are Italian, that's my heritage. And what I find is always beautiful when I come back to the ECBC into Europe, it's really the diversity that actually really, to my mind, actually is the strength. It's that collaboration of so many different cultures coming together. So it's something that is really just something I think is really impressive, and is anything that really I can probably help do going forward as well is constantly try and sharing that. People actually think that sometimes actually having diverse views is sometimes a weakness in the sense of you don't get things done quickly. To my mind, it's a strength. It's a big strength. If you work together with all our different backgrounds and knowledge, you're really only going to achieve something that's much, much better. But anyway, I'll start with what I was looking to present today about, and today is about just providing just a bit of a snapshot around what the Australian and New Zealand covered bond market and portfolios look like, to actually highlight pretty much the similarities in terms of what we do in the Australian context, but also trying to also highlight the similarities in terms of what we do also in relation to when we actually look at the European issuers themselves as well, when we actually think about things like equivalence as well. So just starting off very quickly, as a very much snapshot, I'll start with Australia. I mean, for me, the key features of the Australian market are very much around sort of the strengths of really the actual housing market itself, the strength of the banks. In Australia, you actually have a kind of relatively unique scenario where you have, it's a AAA rated sovereign. In Australia, there's not many AAA rated sovereigns that are going around. Very stable government and legal framework in Australia. And the banks themselves, they're pretty much a double A rated banks in terms of the actual major banks themselves. So for us, we actually see covered bonds as incrementally beneficial to us from a capacity perspective. You don't really get that much of a pricing benefit out of issuing covereds versus being an issuer that's a AA rated anyway. So from our side of things, we actually do appreciate that what covered bonds allows us to do is expand the universe of investors that are able to actually buy into the Australian product. Again, I think we actually look at the bottom of that chart itself. It actually looks at the caps that are in place in the Australian context. At the moment, the cap in Australia is 8% of total assets in Australia. And you can see that chart at the bottom right, we're well below the cap. We always have been. Something that I probably might just pause on, it's actually quite a unique thing that's actually come out recently in Australia, is that the Council of Financial Regulators, that's where the key regulators come together. That's being APRA in Australia, our banking regulator, the Reserve Bank of Australia being our central bank, and ASIC being our actual company's regulator as well. They come together, and what they're actually proposing is to actually increase the cap in Australia from 8% to 12%. And also what they're looking to propose in Australia at the moment as well is to actually also have covered bonds qualify as HQLA, level 2A. And it's actually something that we see as a major step going forward. It's something that will, I think, actually help with the equivalent story in Australia itself. But mainly the reason for that in the Australian context is really to try and actually help the small and medium-sized banks. Because as you can see from that chart at the bottom right, increasing the cap for Australian major banks is not really going to deliver us a big benefit because we're already well below the utilisation levels. What it will do is actually give more capacity for the smaller banks to start utilising covered bonds as well. So that's really a big positive from Australian context. It's not something that's set in stone yet, so it's actually something that's actually being planned. So it's not a done deal, as we'll call it in an Australian context, but it's actually something that we see as a really positive step by the regulators to acknowledge the actual need as well to try and actually expand the ability for us to continue to issue covered bonds from the Australian context. If I turn to the next slide, again, I touched on the mortgages themselves in the Australian context. If you actually look at the Australian mortgages and you look at through the global financial crisis and the like, they've always really performed really well. And I always come back, there's a number of reasons for it. It's not really just the underwriting standards of the bank. There's quite a big framework around the legal framework in Australia as well as the tax framework in Australia that constantly creates this outcome at the end of the day where more broadly our LTVs are actually much, much lower than what they normally would be across the world. And where you actually look at that, if you look at the chart on the bottom left-hand side, I could actually say, I looked at that chart like 15, 20 years ago when I started doing this, and it's been the same sort of thing time and time again, that on day one, on average, a borrower comes to Westpac, all the major banks in Australia as well, and they usually actually have a deposit around about 30% on average. So LTV on day one is around about 70%. But because of the tax framework, the legal framework, and also the products that we have in Australia, there's a very big encouragement for you to pay off your home loan as quickly as possible. In Australia, your home loan is not tax deductible. Your principal place of residency is not tax deductible. And so as a result of that, what actually happens is that the best financial planning that you should ever do is to pay off your home loan as quickly as possible. It's actually debt that you have that is not actually tax efficient. And that's what actually generally happens in the Australian context. And then as a result of that, the actual banking products that are offered as well also encourage the ability for you to actually pay off your mortgage as quickly as possible. So there's elements like they call it redraws. So if I pay off my loan faster, I can still pull the loan, the actual excess balance that I have out of the loan if I choose to. Not many people do, but you still actually have that option to do that. And also there's things like mortgage offsets as well, where you can actually put money on your deposit and the interest that actually otherwise is going to be offset by the amount of money that's on the deposit at the same time. But more broadly, what that means is that if you actually start on day one with an LTV of 70% and you actually look at where is actually the actual balance sheet over time, you get to an LTV at the end of the day that's below that 50% level. And again, that's a testament to what you see in terms of the Australian mortgage market. And to my mind, when you actually looked at periods like the global financial crisis, you looked at periods like COVID as well, it's always been a scenario of actually people actually getting ahead of their loans more broadly that actually has created sort of the resilience within the Australian mortgage market. And really, like I keep saying, that to me is the key. And again, this is just again another chart showing the same thing, that we actually look at the propensity of people to be ahead of their mortgages. Again, you know, as time's gone on, and including through periods like COVID, if anything, has actually been increasing, which again is a very sort of important sort of highlight to my mind around the resilience of their housing market in the Australian context. And then we actually look at credit quality itself. Again, it's not unusual. I think it's probably something that you see in the Australian context, that we actually look at sort of all the different sort of types of credits that you have, including consumer finance, which is a chart on the bottom left, is you're not actually seeing a lot of stress actually coming through the actual banks themselves. And it makes sense at the end of the day. What you have in the Australian context is that buy now, pay later part of the actual consumer credit market has actually been something that's actually kicked off quite strongly in Australia. So we actually even look at things like credit cards in the Australian context. Credit cards are not what credit cards used to be in the past, where people used to use it for credit reasons. The credit cards in Australia is largely now being just that transactional type account where you get your points for actually, you know, like for using your credit cards, and people actually pay them off very quickly. So you're not seeing consumer stress coming through the banks anymore. You're probably seeing it more coming through sort of those buy now, pay later sort of entities. Again, which is actually, again, a key theme in Australian banks. And you can see that's actually those delinquencies and like that actually go through time as well. And then we actually look at the Australian housing market itself. I think the unique thing that you look at the Australian market is that you look at the size of Australia, it's actually pretty much the same size geographically as what you see from the US. It's massive in terms of land mass. But realistically speaking, you really only have two major capital cities in Australia. I mean, you actually look at the chart on the bottom left. I mean, Sydney and Melbourne actually have a population of just in excess of 5 million. And when you actually go to Brisbane and Perth, you're looking at 2 million people each. And then you actually go to the other cities, they're much, much smaller. So massive land mass, but very much concentrated in terms of the eastern seaboard, in terms of the economic activity itself. And from that perspective as well, you look at the actual housing market more broadly, you're seeing that average house price growth in Australia has been around about 5%, which is actually, to my mind, it's a good number. It's a number that actually shows sort of resilience in terms of it's not too large, in a sense you're not likely to actually see a bubble or anything like that, but at the same time it's actually still sort of some high level of growth, which is also still important. And it shows in a, you know, quite frankly in the Australian context, the top of that chart actually shows where there've actually been the rate cuts primarily as a result of COVID and the like, and where there've actually been the recent rate rises, and then also the recent rate cuts themselves. When you actually look at the Australian market itself and the Australian economy, it's actually been reasonably strong. We've only had a couple of rate cuts, 3 rate cuts so far, and the debate in the Australian market is really around the likelihood and need of actually having even further rate cuts. So the economy is actually still going reasonably strong without really actually having a high propensity of having rate cuts at the moment, which I think is a good thing. I was reminded by a friend of mine that I've known for a number of years that talked about there's no such thing as a strong economy that has very, very low interest rates. There is no such thing as that. And it's actually quite funny because we've kind of almost grown used to actually having low interest rate environments and probably forgotten that sort of that key message at the end of the day. But from an Australian context, I think the key point I'd make is that the economy itself is actually going reasonably strongly without the real need of the rate cuts. The debate at the end of the day is whether we actually need them or not. So it's quite a unique sort of scenario from the Australian side of things. Again, I'm not going to go through the pool stats themselves. I'm sure a lot of the research people have actually put a lot forward here. But again, all I just really would highlight is that the covered bond pool itself is just going to be a reflection of the underlying mortgage portfolio that I already touched on. Again, it's also going to be a reflection in terms of the geographic location of the loans, very much in line where you see the economic activity of the Australian market itself. And I won't go through all these in detail. And then we actually look at the New Zealand market by way of contrast, very similar in terms of sort of positioning in the Australian market itself, very similar. The only difference is between really the Australian market and the New Zealand market. The New Zealand market's a lot more concentrated, smaller economy at the end of the day. The Australian economy is a lot more diverse than what you actually see in the New Zealand market itself. So what you generally see in the economic standpoint in New Zealand, you'll see probably a little bit more volatility in sort of the ebbs and flows than what you would see in the Australian market, mainly because the fact is that New Zealand is actually, these industries are a lot more concentrated than what you see in the Australian context. But from a mortgage portfolio itself, again, very much the same sort of theme, low LTVs in terms of the mortgage product, very similar underwriting standards, very similar sort of legal frameworks than what you actually see in the Australian market, and very similar products, so not a lot of difference. The only key differences I'd say between the Australian sort of mortgage market and New Zealand is that the Australian market is largely a floating rate market, so the majority of our loans in Australia are floating rate, probably around about 90% or above of floating rate loans, where it's almost the opposite in New Zealand. So, but when you actually look at the New Zealand market around sort of fixed rate loans, again, they're not really long dated fixed rates. The fixed rates are generally only between sort of 6 months to 18 months. They're not really like long dated. But what that means in the New Zealand market versus the Australian market is that you're still going to have a bit of a lag, probably around about that 12-month lag between a central bank reducing rates and actually seeing sort of that flow going really truly into the economy, whereas in the Australian context, you see it almost immediately. Again, you look at the mortgage stats itself, and in terms of delinquencies and the like, again, I'd highlight that our mortgages in Australia, I keep on saying it's actually a very strong track record, very resilient and the like. I'd say that New Zealand, would say it's that plus more. And the key reason for that, again, is there's one added interesting piece about New Zealand that people tend to forget about, is that New Zealand went for probably a period of, and it's only just recent when it's starting to wind that off a bit, for a period around about between 6 to 8 years of where they actually had quite punitive macroprudential standards put in place. And those macroprudential standards were really designed to slow down the economic growth in the housing market in New Zealand, and are quite punitive, where at one stage they had speed limits where we could not actually lend in New Zealand above 60% LTV. And to my mind, it's created an unusually strong mortgage book that over time, as you wean that off, you probably would find that the book would probably be more sort of performing in line with what the Australian book would be. But at the moment, it's actually performing even better. And it's probably not a bad thing at the moment, because what you see in the New Zealand economy more broadly is that it is actually slowing. And the contrast between Australia and New Zealand is that the New Zealand central bank has actually, gone to, they're now about the 4th or 5th rate cut at the moment, and they're still not seeing the actual growth come through. It's not where we're seeing sort of a shrinking of the economy or a material shrinking of the economy, but they're finding it hard to reboot the economy. So from a housing context perspective, you're seeing the New Zealand markets been performing relatively flat, but the forecast going forward is that they probably would start seeing a sort of housing price growth of in the order around about 5%. And the reason for that housing price growth that's going forward is mainly as a result of the thinking behind those rate cuts will start to actually kick through to the marketplace itself and start actually really creating that benefit. But again, to my mind, part of the reason why it's actually taking a bit of time for the New Zealand market to actually start rebooting is, again, because they do actually have a slightly longer fixed rate portfolio, and you need to actually wait for that to wind off. Again, these are sort of the key stats that actually to actually highlight what I just actually spoke about. The only thing before I sort of just might open to one or two questions is what we did actually highlight in the pack, and this is actually going to be available through the piece. There'll be a link to this to our website where you'll be able to actually get it off our website itself. But what we tried to do actually at the back of this pack as well is to really highlight again the similarities between the way the actual covered bond portfolios are actually being put together from an Australian and New Zealand context. It's really important to actually appreciate this. When you look at nearly every aspect of the portfolio, it is by no way by accident that we got to a position of actually making sure that everything that we did from a statutory perspective, the best we could, from a regulatory framework, and also from a underlying documentation perspective, is to create a similar portfolio that we could to the Europeans as best we could. Now, again, by way of context, Australia and New Zealand are both English law jurisdictions. As a result of being English law jurisdictions, what we tended to do is actually follow more what the UK issuers did in terms of their structure of their portfolios. Again, another English law jurisdiction. So from that perspective, what generally happens in those sort of marketplaces is that when we create a covered bond pool, we create it by way of legal segregation, by creating an independent trustee that we sell the assets into. But those assets still are on balance sheet from a banking perspective. And really what it does do is actually highlight, like I said, when you actually look at nearly every aspect of the comparison of the covered bond frameworks in Australia and New Zealand, very similar to what we actually see in terms of European context, which again is really important as we actually start looking into sort of equivalence. And again, it's no way by accident that when we actually established our legislation in Australia, we followed again what the UK had done. We followed at the time what the Canadians had done in terms of the contractual arrangements, and New Zealand and Australia actually clearly followed those jurisdictions. Then when Canadians actually put their legislation together, and then when the Singaporeans put their legislation together, they then followed what Australia did in terms of the legislation. So what that actually means is that you'll see from a broader equivalence perspective, those key jurisdictions between the UK, Canada, Singapore and Australia are going to have very similar frameworks. And again, it's no way by accident. So that is actually, again, a net positive as we start trying to sort of get into the discussion around equivalence in terms of covered bonds. So I might just pause there and see if there's any questions. Yeah. So in the Australian context, there's still actually some form of mortgage insurance that is in place. It's not the biggest part of the marketplace, but generally speaking, when you actually get to a position where you have a riskier loan, so that might be from an LTV perspective or the like, there is still a mortgage insurance market where we still can actually go and get the actual underlying loan insured by an independent mortgage insurer. But again, it's not a big part of the marketplace itself. And again, we actually see the propensity of the loans that are generally written at sort of that higher LTV. It's a very small percentage. It reflects the fact that only about 9% of our portfolios are mortgage insured. They're not AAA. They probably would be more sort of that single A to AA rating more broadly. So there's quite a number of them, like QBE will provide that types of insurance and the like. There's quite a number of players in the marketplace. But again, we don't say there's actually the actual banks themselves don't pay that insurance. It's the underlying borrower pays that insurance. It's been something that's been in place for a long time. So while the banks don't place a lot of value against that insurance, it's always a nice to have. And if the borrower's going to pay for it anyway, you might as well take it. So that's kind of the thought process behind it. But it's just kind of, like I said, is kind of additive in terms of benefit. I still see the fact that, the actual encouragement for people to repay their loans over time and actually creating a scenario that you very quickly get to a portfolio an average LTV around about 50% is the key, to my mind. He's not really that reliant eventually on the insurance either. You don't want to be reliant on the insurer. I think that's the key message from my mind. All right. Really appreciate it. And like I said, this will be available through the packet. If there's any further questions, you can come and see us all.
Okay, allow me to take the opportunity to share our secret operation at the ECBC.
What's that?
Well, we have a very ambitious dream. We want to bring cover bonds in level 1 and level 2 all over the world. That's we want to create a real investor basis. So we are very active on the ground, thanks to Guy as well, to move all the issuers down under, so Australia and New Zealand, but also in Singapore, really to be a bit the flagship in this movement to open up a global investor base. The ECBC has been discussing, this afternoon we will discuss in the steering committee, so we are putting all our energy to move local issuers, to push this with the national regulators, and getting a bottom-up approach, I will say, entering from the house. But together we can really try to make a big change. I think having covered bonds in level 1 and level 2 all over the world will be a bit of the revolution. We are putting our brains, our energy, our sympathy to make this happen. So, I mean, we can say this.
No, but I actually agree with that, Luca, because I think at the end of the day, being from the bottom-up approach, literally also geographically, where we're actually literally at the bottom of the world as well,
Yeah.
we're actually quite frankly used to the fact that we have to explain to people what we do. It's in our DNA, because we know that at the end of the day, Australia's not going to be in the front of the sort of people's minds all the time. And really, I think where we look at it from equivalence or we look at it from any other aspect, really, when I keep coming back to the key theme is to make it easier for investors to understand what we do. And the way to do that is to create as much as a similarity as we can. And if we can actually highlight those similarities, I think it actually just makes things easier. The equivalence is part of that, but it's also things like, we touched on before around